Hi everyone, on this week's episode of Tech Talk, I wanted to take us through the world of credit scoring, how that can impact businesses, but also what business owners can do about it. So I've been joined by Toby of Capitalise, who's going to take us through some of those insights and hopefully introduce us to some tech that can help company owners improve their credit profiling. And welcome to Ascentis TV, Toby. Do you just want to tell us a little about yourself and Capitalise?
Yeah, sure. Thanks for having me, Lee. So I'm Toby, and I'm a partnership here at Capitalise. What Capitalise does is we partner with accountants to help their clients access a range of services to effectively help them raise, recover, and protect the capital within their business. So we help with a number of services, whether it be helping businesses access finance, helping businesses understand their credit score, which is something we're touching on today, or if it's helping with credit control and actually recovering money and bringing capital back into their business.
Excellent. And just kind of looking at that credit scoring, why should businesses actually take an interest in credit scoring?
So it's an interesting one. I mean, we partner with Experian, who obviously are one of the biggest credit agencies globally. And so what we've learned through our work with them is that a large number of businesses don't really pay attention to their business credit score. In fact, only 29% of business owners actually know their credit score, which is quite a strange fact because people are always taught to look after their personal credit and stay on top of it. If you're applying for a mortgage or anything like that, that will be the driving factor. And so it's strange that business credit doesn't really get the attention that it really needs. Now, there are a large number of reasons why a business should look after their credit profile, and it really does depend on the sector they're in the industry. If you're a business in construction, your credit profile will be fundamentally significant to how you operate as a business, whether it be tendering for new business, whether it be relying upon the supplier terms that you have with your creditors and actually the credit that they can extend to you to help with your cash flow, or even looking at the funding side of things for all businesses. Lenders will look at your credit profile before the application goes into underwriting. So making sure that you're staying on top of that is really, really important. Now, one thing we've seen across the board is a 9% decrease in credit scores, and a lot of lenders and suppliers and creditors as a whole are actually increasing their minimum credit score for applications, for payment terms, for all these different avenues, simply because of a credit profile. And if businesses aren't paying attention to this, it could ultimately affect the way that their business operates. So we're really trying to look at how we can get this information back into the hands of the business owners as it is their data, and really get them taking control of their own credit profiles.
Yeah, there's a huge amount of external stakeholders in a business who are constantly looking at credit scoring without businesses actually being aware of that sometimes. You mentioned that 9% decrease in credit scoring across the kind of the UK in full. I mean, what are the kind of external issues that are affecting business credit at the moment?
So really good question. I mean, off the back of the pandemic, we saw a blanket decrease in credit scores just because business performance typically was worse and there wasn't as much information going out there. I mean, in terms of external factors, it's less the immediate impact it has on a credit profile, more of the impact it has on businesses as a whole and changes in their behavior. Now, if you are a credit agency bureau like Experian, you are basing a credit profile off the information that's available to you. So if you've got a business that files micro accounts or that has a short amount of trading history, their credit score is going to be affected. And now Experian can't go in and see what the impact of rising energy rates is going to be on that business. They're not be able to see how they have been able to trade through such an uncertain time. And also business owners might be thinking differently about how they're operating, and that may not translate to experience. So what we see is in times of uncertainty, whether it's political, economical, environmental, businesses will change their habits. And it may be that they delay their filing period so that the numbers look better, or it may be that they change directors, and a frequent change of director will indicate a credit score decrease to an agency. And so by changing those behaviors to an agency, it looks like something's going wrong in the business, but it may just be the business reacting to external pressures on the way that they can operate. And so that's why staying on top of a business's profile and what is feeding into that, what's having a positive and what's having a negative impact on that profile is really, really important.
Yeah, so you've touched on a few points there, but what can businesses actually do themselves to help increase credit scoring?
So as I mentioned, it's all about building good behaviors. It's all about consistency. And so if you're looking at naturally improving your credit score, it's about making sure you file at the same time of the year, making sure your accounts are showing higher assets than liabilities, making sure that you are showing healthy growth and trying to build in a steady way. Any volatility, any quick changes will flag up to an agency and they will automatically perceive it as negative. So unless you can go back to Experian or any other agency and explain those changes, then they're going to hold you back for it. A prime example is we worked with a very fast pace startup who changed their office location 3 times in a year simply because that's the rate of their growth. Now, their credit score shrunk because it looked like the business was in distress because they kept on changing offices, whereas it was actually a good thing. And so that's the kind of thing that you need to be making sure there's consistent patterns, or if there are any sudden changes or different things, then you are looking at going through Experian to explain that and mitigate that so that they can give you a more representative credit score.
Yeah, we've found as well that having just the right SIC code at company's house can actually have an impact on your credit scoring. So have a look at that, make sure you get that correct. So obviously, that takes us really into why we're here with Capitalise, and you've got some tech that can help people. Do you just want to tell us a little bit about that?
Yeah, of course. And as I mentioned, through the partnership with Experian, they really tasked us to come up with a service whereby business owners can check their credit score on the go and just stay on top of their profile. As I said, taking ownership of their own data. Now, typically a credit report can be 18 pages with graphs and loads of different jargon that a business owner may not understand. And so what we've done is translated that into a very simple credit profile, which breaks down their credit score, their credit limit, how different factors are impacting their score, whether it's positively or negatively, how their payment performance is, so how creditors are viewing their payment performance. And we've also given them the opportunity to track and monitor other businesses' credit scores. Now, what we've seen is that only 1% of businesses are currently doing this, currently tracking the businesses that they work with. But those 1% are 6 times more likely to successfully achieve funding, simply because A, their credit score will be higher as they're demonstrating good behaviors, but B, they're also tracking external threat to their business. Instead of a debtor going bust and not being able to pay them, they can see that that debtor's business is deteriorating and go in and change the way they operate, maybe ask for cash up front as opposed to 30, 60 or 90 day payments. So it's how can we build those healthy behaviors, track and monitor the businesses around them, and also stay on top of their own credit profile. And there also is an ability to review your credit score and look to improve it.
I mean, it sounds so simple, doesn't it? It's just good business sense to do credit checks on all your customers and suppliers. But anyway, that really takes us nicely into a little demo. So can you show us around, is it client tools you call this tech?
Yes, client tools. And I can dive in and do that now. Yes, so Lee, as you mentioned, this is the client tools profile. And so what we can see when you first log in is the today page. So this will give you an overview of any updates in the past 30 days. It will give you a breakdown of any changes, whether it be increased credit score, whether it be increased credit limit or decrease if the score's gone down, and also any changes to the companies that you are monitoring. We then could dive into your credit profile. So this is your full Experian credit profile. And so this gives any risks that the business may be facing to their credit score. So we can see that at the moment, the business is perceived as low risk, which is a good sign. There are 1 negative risk factors. So these are the different, a handful of different factors that are impacting a credit score. So we can see a positive factor is more equity than debt within the business. So that's actively driving the score up. We can see that potentially a negative is their payment performance. And so on average, the company is considered to be performing worse than the industry average, which is something I'll touch on shortly. We can see their full credit score and also a trend of credit history. Now, this is super useful because a lot of business owners will say, I don't need a strong credit score because I'm not looking for funding. Now, in such uncertain times, I personally think it's impossible to say that a business will not need funding over a 12-month period. A lot of lenders, when looking at credit profiles, will look at a 12-month history and average when basing their credit reviews. And so if you can stay on top of your credit profile early, then when you are looking for funding, it will give you the best chance of getting that application into underwriting. We often see businesses that were sitting on a low credit score for 10 months, then saw a massive improvement, look for funding, but still get declined for poor business credit. And that is because they will look at a trend over that 12-month period. We then can go down and we can see the payment performance. So this is how other creditors are feeding back to Experian on your business's payment performance. So if you've had any late payments or missed payments, typically the likes of banks, lenders, credit card providers, energy suppliers, or big, if you're a construction industry, big suppliers like Travis Perkins, Juicens, they will be feeding this information back to Experian. And this is publicly available. So as Lee said, a lot of businesses will be credit checking each other and they'll be able to see this. So making sure you're staying on top of payment performance is really, really important. And then at the bottom here, we have a breakdown of the credit and bank accounts that that business has. So you can see any credit that's extended to them, whether it's a loan, whether it's an energy supplier or a telecommunications supplier, and then also their current bank account and how that bank balance is looking. And then at the bottom as well, you can have a look at any funding opportunities. As I mentioned, yes, we do help with credit massively, but we also help with funding, as credit really is the start of that journey, making sure the credit profile is healthy and up to date, and then looking at a further funding journey. So you can also look at what funding options are available to you.
But this is matching you against lenders that are likely to lend based on your credit profile. So there's no wasted time going down
exactly
roads that are just not going to happen.
Exactly, yes. We then have the monitoring aspect. So how we can track and monitor other businesses. And what we can see here is the business that you've selected, how many risks that are detected under that business, their payment performance trend, their credit score, and their credit limit. And if you click into that business, you can see all of that broken down. Now, as Lee and I mentioned earlier, this is really, really important as it's good, healthy behaviors. You're tracking the businesses you're working with. You can stay proactive when anything changes. But B, given the rate that insolvencies are going up, you want to make sure that your business is protected from those other businesses that you rely on to operate. So if your biggest supplier went bust and you didn't find out, how would you then continue to trade? If your biggest debtor went bust and you only found out when they couldn't pay you, how would you be able to recover from that? And so being able to track and monitor any changes to their credit scores, to their payment performance, anything that should be ringing alarm bells, you can all see in one place, which is very, very beneficial. And so that really is the client tools. You can monitor other businesses, you can check your own credit profile, and you can just stay up to date with all of these different elements that ultimately will be impacting your business.
Yeah, and very importantly, even if, for some bizarre reason you're not interested in it yourself, your suppliers and stakeholders will be doing this on your business. So it's really important, like you say, to get a hold of this information before other people do and be able to react accordingly.
I agree. I often speak to business owners and they say, I'm not interested in my credit profile. And unfortunately, a credit profile, as much as it could be, isn't a nice to have for a director. it is a tool for other businesses to check the creditworthiness of that business. So other businesses will care about your credit profile. And so staying on top of it and building out healthy behaviors is super, super key.
Right. Thanks for that, Toby. Fantastic demo. Now, I mean, you are going direct to market with this tool, aren't you? But for all those clients of Ascentis, watch this space. We'll be sending you a link direct with your own logon details on it. So that just leaves me to say thank you very much, Toby. It's been insightful. Really appreciate that.
Thank you very much for having me, Lee.
Take care.
Cheers.